Good morning, everybody. Welcome to our weekly webinar. We'll give the market outlook, and then we'll talk about the REIT sector. Usual disclaimers. Okay. Last week we talked about the fact that machine orders in Japan and the US are starting to pick up, right? Okay, so this week we're going to talk about the Singapore export results, which came out, and which caused quite a stir because the latest print for non-oil domestic exports, which is the chart on your top right, registered a monthly decline, okay, which was about 9.9%. So this got some commentators worried that we're going to have a very weak trend going forward in terms of economic data. However, we don't think that this is going to be the case. I think the rest of the year for Singapore is actually going to be, it's not going to be fantastic, but I think we'll be at the upper end of the 3% GDP print that MTI is forecasting. Okay, for the chief reason is, although non-oil domestic exports, the latest print was rather weak. I mean, on the smooth trend of 3-month moving average year-on-year data, we actually seem to have bottomed out. And if you take the non-oil re-export data, we have had a huge rebound. And if you look at the overall gross exports of Singapore, we are actually starting to turn positive. Okay, and if you take the global context of Japan and the US, both, I think, will put in a decent second half, and Europe is getting better, not worse, in terms of economic data. Then I think the global context is pretty good. China, as usual, remains a bit of a wild card, but we also do note that reforms are starting to take place. Most recently, China has eliminated the 30% below benchmark floor on lending rates. So that means we could see greater competition amongst Chinese banks to lend out at lower rates, which can only be good for the economy. And one more step closer to liberalizing the deposit rate, I think this sends a positive signal that could actually happen. And if you raise the deposit rate, because deposit rates are pretty much artificially low right now in China, being capped at I think 10% above the benchmark. Actually, Chinese consumers are being underpaid for the deposits. So if they're being paid more, we could actually see a bit of boost to consumption there. Also in Japan, Abe's coalition has won the upper house, which adds to their win of the lower house in December. And so the market will now anticipate greater structural reform as the political impediments have been removed. We're looking at labor market reform in the agricultural sector as one of the key catalysts going forward, and also reform to make the Japanese corporate tax rate more competitive as well. Okay, let's move on to the market analysis.
Morning for market analysis. We're talking about the business cycle, and we'd like to reiterate that at present, we think that we are at phase 4 of the business cycle, and in this phase is characterized by a weakening of bonds. Might be the start of a longer bear market for bonds, and stocks and commodities still have room to run. That's how phase 4 is characterized. And so we base our strategies on that. An update of the dynamic yield curve. We know that the yield spread between short and long treasuries, when they flatten out or get inverted, they're usually leading indicators of bear markets. Right now, as you can see on the chart on the left, that we are actually very far from actually flattening out. So this lends itself to support our stand that stocks still have room to run. till the end of the year. Based on phase 4 strategy, we also like to say that we are approximately a ways to the top of the bull market for stocks, and we could concentrate our sector trading in energy and basic materials. Here's the intermarket relationship for 10-year treasury prices, the S&P second, and thirdly at the bottom GSCI futures. This is for industrial commodities, crude oil as well as industrial metals. As you can see, the top chart, that treasuries have been on a multi-year uptrend, and only recently in the middle of this year we had a strong downtrend. Is this a sign of the start of a bear market? We're not sure, but this is a strong sign of weakness, and that's why we suspect we could be in phase 4. Stocks have been on a continued uptrend, and well, it's still on a continued rise, no top in sight yet. For commodities, we suspect that this downtrend is more of a consolidation pattern rather than an actual downtrend, as we will see in the next slide. Here is we zooming in deeper into the 3 asset classes. The first chart here, you can see for the 10-year futures, for the past few months, we have been on a rather steep decline, and until this blue line has been penetrated, we are going to assume that the downtrend will continue. S&P is on a continued uptrend, no top in sight. Now, for the GSCI futures, we see that just this month, there has been a breakout from this consolidation pattern over here. So stage 4 business cycle thesis is still intact for now. To support what we mentioned about commodities, here we see the relative strength charts and the chart of the oil service sector prices, index prices. So the top chart here is the WTI, which is the West Intermediate crude prices, West Texas Intermediate crude prices. As we can see, that just last month there has been a breakout, and we are above $100 for crude. In combination to that, we see that the OIH, which is the Oil Service Sector Index, has also had a breakout, just broken out, and we want to see the price remain above this support line. If so, that is actually bullish for the industry. And finally, for the sector, and finally at the bottom is a relative strength chart of the OIH and the S&P weekly. This measures relative strength. Okay, and we can see that there are signs of bottoming out. So this is a good sign. If this does turn, that will signal that it's the start of the oil service sector taking leadership, which also supports our phase 4 strategy case. Okay, so here are the technical analyses of the major indices. This is the S&P 500. Essentially, we are still on an uptrend. In fact, we are in a channel, and it's just continuing on. Uptrend is still on. On a closer look on the daily, we see that prices have reached out at all-time high, and as long as we can stay above this red zone here, which is all-time high, that will be bullish for the S&P. Here's the S&P chart. We put 4 charts here for you to compare and to see the correlations between the markets. And we have the S&P here, followed by the STI, followed by the Hang Seng, followed by the CSI 300. And of the 3, you can see that of all of them, 3 of them are actually in long-term uptrends, with US leading the pack. The only one that's in a downtrend is actually the CSI 300. However, we also see that starting from 2012, a base could be setting in. So we see that all 3 markets are actually in an uptrend, with a base setting in for the CSI 300. So we believe this is bullish in general for stocks. On the Nikkei, we have recently broken out of this resistance line over here, and as long as we can stay above it, we believe price will challenge its all-time high, or rather its yearly high. For the Hang Seng, on the short term, we are still essentially until this blue line is broken, we will assume an uptrend is in order. On the daily, we see that price has been negotiating, attempting to break through this resistance line, and we must keep our eyes peeled on this, because if this blue line does get broken, then and we can hold above it, it will imply further upside, probably to 23,500. So we keep our eyes peeled on this level here. The Thailand index is on an uptrend until the blue or the brown line is penetrated. We assume uptrend is still on. When we go deeper into the Thailand index, we see on the daily that on Friday there has been a breakout of this support resistance line over here, and we want to see if price can stay above this, and if so, we believe a probable target will be in the blue zone here, our first target, okay, which is between 1550 and 1575. This target is also the 62% feeble retracement of the last down leg that started in the middle of May till July. Jakarta Composite Index, same story as Thailand. It's also on an uptrend. In this case, although Thailand has broken out, the Jakarta Index is still negotiating its own resistance line, and we must see whether this price can break out of this line as well. KCL Index still on an uptrend. And finally, for the STI, we note that price has bounced out of the 3,100 70 MA support, and is approaching or bounce off this blue line over here. On a closer look, from a previous call, we mentioned that there was going to be a short-term bounce between 3210 and 3260. Subsequently, after bouncing off the support at 3060. So since then, price has actually made it to almost 3260, in fact 3259, before stalling for the last few days. We believe probability is still to the upside, although we must see whether price can actually break through the resistance at 3260 with conviction. If so, that will imply further upside. Thank you.
Okay, now shall touch on the REIT sector. Okay, the agenda for today, we will first identify the REIT trend, give you an update of what's happening on the price movement. Second, we'll identify the different drivers and obviously the one that's causing the drop in the REIT price. And we'll look at the potential direction of these drivers so that we can have an indication of where the REIT sector is heading towards. Next, we will actually give you the sector strategy recommendation, which is roughly what you guys should look out for, and the remaining just market information and highlights. Okay, to start off with the current price and price trend. In 2012, the REIT sector actually had quite a good show. The main reason is because of the low interest rate environment. There's a stable and resilient rental growth, and also stable and strong real estate fundamentals. And there's better dividend yield as compared to the neighboring regions. Singapore ranging 6 to 6+%, whereas Australia is about 5, Hong Kong is about 4.7, and Japan about 4.3 as of 2012. It's also another reason is based on the strong Singapore dollar, and also due to the liquidity and improving leverage situation for the REITs itself. Riding behind this theme, there was actually we consider internal growth for the REITs, and they actually outperformed the broader market. In 2013, this there was some momentum carrying forward, and you can see that in April and May, they actually rise much more than the STI index itself. However, these factors are increasingly being priced in, and there's a potential, there's an increase in, not potential, there is an increasing interest rate trend that can be seen. So moving on to the next slide, you can see that year to date, there is still about half of them who are up as compared to the start of the year, whereas the rest has started corrected. But over the main story right here is actually over the past 3 months, all of them were actually demonstrating negative growth. So this is a good summary of how the market is performing right now. Moving on, okay, with all the other factors holding stable, the rental growth, the story are still intact. Currently, one of the main factors that's driving is the increasing interest rate. This is like a summary. FOMC will actually hold 8 meetings a year, and in the 30th May meeting, the minutes was released on 22nd May. 30th of April meeting, the minutes was released on 22nd May, and it gave an indication that they could taper their asset buying structure, the quantitative easing in over the next 2 meetings, which will point to the scale back in second half of this year, which is just a few months in the horizon. So it induced the market to expect such a scale back of asset purchases, and the most recent one will be the July release of the transcript for 19 June. So here is where you can see there was actually no news for the July 10th at the 19 June meeting. So as in the interest rate is seen sideways towards over these past few days. But having said that, we can see that we should now look into the correlation between the Singapore government bond yields and so between the REIT pricing. You can see that the magnitude is similar as the interest rate rise from the 22nd of May up till now. The REITs actually took a same dip in their prices, so that we feel that there's this negative correlation that's driving the market driving this sector right now. We reckon that the parallel yield of the government bond, okay, will not resurface. So we expect this yield to reach the interest rate to reach about 3% thereabouts. So we would next want to look at the yield spreads, which is also the difference between the S-REIT yields and also the government bond yields, to get a rough idea of how an increase in the interest rate and the lowering of the yield will actually impact the S-REIT prices and the yields as well. So although historically there's quite low correlation and the yield spread is quite unstable, okay, over the recent this year alone, okay, it was ranged bound between 4% to currently about 2.3, 2.4%. So the yield compression was driven by low interest rate previously now, and the long-term average is about 3.8%, which is the most likely scenario is that this yield spread will remain stable. There's little justification for yield spread to widen because there is actually no major deterioration in the underlying market real estate fundamentals, and that we feel that it's going to be in terms of the underlying real estate fundamentals, okay, it's still going to be a stable, although it's minimal year-on-year rental growth over the next 12 months. So, yep, to recap, we feel that the yield spread will remain at current levels or maybe slightly higher. In terms of valuation, historically, okay, the market has always traded about at 1.03 times book value. We felt that the prior run up to 1.2 times book value over the April and May period is way above the long-term average, and that the potential ending of quantitative easing actually serves notice to investors. So they actually came back down to the long-term average. Once again, we did not foresee much deviation from this price to book value. In terms of dividend and leverage, this allow me to first let's in terms of the leverage ratio, okay, the reason why we actually present this to you guys actually to give you guys a rough feel about how much exposure does the individual REITs have towards the increasing interest rate environment. But having said that, it's important to note that most of the REITs will have about 50 to 70% of their debt, okay, hedged against rising interest rate, and or they have staggered the debt repayment period. So we feel that in terms of the S-REITs itself, due to over the past year, they have always been improving this their leverage situation. They will not be that heavily impacted. Going forward, okay, the recommended strategy would actually be that you do not fish for a bottoming out of the REIT sector, or rather focus more on those REITs that have strong sponsor and have demonstrated track record of acquisition. We are looking more at the commercial, is in the office REITs, and also the prime retail REITs. We feel that in this based on these investment teams and the fact that they have strong growth potential, they will actually have more upside as compared to the others. And also do watch out for the REITs that have higher leverage. Also do watch out for those that are due for financing. We prefer those that have recently refinanced their debt, and or they have already lowered their refinancing list through hedging of interest rate as well. So that is all. Thank you for listening in. Is there any questions? Okay, there's a question. The question goes, which of the two IPO REITs, namely SPH or OUE Hospitality Trust, is a better buy in terms of yield and capital appreciation? Which of these two have better potential and higher yield? And they're asking for any further comments on it. I believe that in terms, these two shouldn't be. Hold on for a moment. Yeah, it's a hospitality. It's about 6 odd. Nothing interesting. So actually there is a lot of trade up. So actually much higher. Hi, sorry. Just was taking some time to actually look into information. So let me answer the first question. Among which two IPO? SPH, we will actually compare these to actually the capital more. We are looking this. We are actually looking. We don't think that these two REITs should be compared to each other because of the nature of the assets. So for SPH, okay, the REIT in terms of the yield wise, we feel that it is slightly above the current market yields. We do think that it can be a yield chasing play. However, we do not see much upside to it because currently the sponsor will be putting in most of their assets, and we do not see much growth potential in it. For OUE, we feel that currently the yields at about 7.2 or maybe slightly higher because they're actually launching at 0.88 cents, the lower of the band. So we feel that here it is much higher. I would say that it is a premium yield. So it should be a buy call on that. Is compared to CDLH Trust, which actually at about 6.8% in terms of the dividend yield. So, and on top of that, there is also potential. There's 3 further potential asset acquisition that you can actually achieve because of its parents. They've actually identified these 3 assets in their prospectus. So, you have a better growth story. We believe that OE would look more attractive in this sense. The second question, hi, how do we check that a particular REIT has recently refinanced? The company normally would actually post announcements, okay, with regards to if there are any refinancing activities or if they have actually obtained certain cash injections for the company. So I believe that through the SGX announcements, okay, you are able to check for the information. There is a request to actually repeat our outlook for the price movement for REITs. So the REITs, we think that going forward it will actually be stable at current valuations. So we are actually recommending that you guys actually look for the REITs we have strong growth opportunity. We do not believe that it's a bottoming out. We believe that it's more of like normalizing and stabilization at current levels. What happened to the audio? Hi, testing. Can anyone hear me? Okay. 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 If there's more long-term downside, that interest rate will eventually rise. Eventually, would this not be a bad time, even if you're looking at price to book? So you should be looking at. Let me see if there are okay. Hi. There's a question from Flor asking if there's more long-term downside to REITs as interest rate will eventually rise. Would this not be a bad time to consider REITs, even if you're just looking at price to book valuation? They are all overpriced for now. Allow me to address the second part first. In terms of price to book valuation, historical average, they are at current long-term average. So I wouldn't exactly consider them overpriced. I would think that it's more of normalization. So the recommendation actually would be to look at individual REITs itself. Do not bottom fish. Try to look for individual growth story, those that are strong, especially with sponsors back REITs. The next question is, does that mean that most of the REITs are fully valued? Currently, the REITs in terms of price to book is at 1.03, but in terms of price to NAV, it is still at a slight discount, with some showing between 70 to 80% discount to RNAV. Compared to a historical average, it seems that this is the valuation that the market is comfortable with. That is also the reason why we're recommending looking at REITs that have strong growth acquisition in terms of pipelines, in terms of sponsor back, whether there's a high potential for more assets through acquisition or through in terms of like purchasing more or either injecting from the parent. So we are actually looking at those who have growth potential. The aim of the day is to look at those with growth potential.
Hi, we have a question here on FedQE. If it's a foregone conclusion, does this mean the uptrend This is the uptrend for both long-term and short-term interest rates. And you could see a flow of funds out of the equity market and the bond market. No, actually the complete opposite. Actually, it's probably going to be a bear market for bonds and a bull market continuation for equities. Okay. Basically, when you're starting to raise interest rates, you're signaling that the economy is getting stronger and inflation is coming back. And when inflation is coming back, all fixed income, that's bad news for all fixed income instruments and quasi-fixed income instruments. And it's actually good news for equities. All right, because equities are able to reprice their products. Right, a business can easily raise its price if it's a good business to be in line or exceed inflation. Right, fixed income, you can't do that. Okay, we have people asking for the slides posted. Well, the slides are emailed out to all remisiers. So if you have a remisier with Phillip Securities, you can ask them for the slides. Yes. Okay. So here we have a question saying, does that, in a rising interest rate environment, does that mean it's negative for REIT? Yes, it does. That's why we're saying in this presentation that you have to look for individual names of REITs, and it can't be a broad sector buy anything and it will all go up. Okay, it won't. Right? You'll have to look for REITs with, like my analyst said, a strong sponsor, so that they're able to increase their DPU, right, to offset a general derating in the sector, right? And so that means they need a pipeline of assets that will be coming in. They will also need lowish gearing, right, to gear up to buy the assets without issuing more units. Those are the kind of REITs which will have potential to weather this downturn, and in fact, some may actually rise if the story is strong enough.
Hi, Lucas here once again. There's a question on Suntec REIT and the potential to accumulate. Can I get and asking regarding the outlook for Suntec REIT? I think recently Suntec REIT they actually announced that their results. So the second quarter DPU was actually slight, there's marginal improvement. However, they were saying that the portfolio occupancy remained high, and the passing rent in terms of the rental rates, okay, is still holding up. From a very fundamental point of view, there's still the Suntec REIT, there's still some AEI ongoing right now. In terms of rentals, we have not seen the full potential. There's still we are still waiting for AI to complete and then growth. But in terms of like NAV and in terms of the valuation, okay, they do understand that they are is really has. We feel my view is that they have already been priced in because the NAV has not been adjusted, even though they are going any AEI. The dividend yield right now is about 6.1% on after we have analyzed the numbers, and currently it is still the only thing in terms of valuation is trading at a discount of about 0.7 price to book. But do understand that it is actually taking quite a heavy bet on the performance of actually quite somewhat of a single asset. So on terms of the outlook, we believe that based on valuation, based on the potential strong increase in DPU upon completion of his AEI, it would actually be quite positive. And we feel that at current price, it do seems that it is a positive outlook for them. And that's it. Okay, we have come to the end of our presentation. Thank you for calling in, and we do appreciate your questions, and we will for those individuals who are asking for the slides, as per mentioned previously, we will be sending it out. Thank you.